Hello, welcome to AllGen's Market Update. My name is Jason Martin. Today is April 29th, 2020. I'm going to give you guys an update on the markets today. Also kind of go over how the market's been bouncing as the daily cases for COVID-19 are starting to drop, and talk a little bit about how the economies around the world are implementing plans to reopen, albeit slowly. So let's hop right in. So what we're looking at here is the S&P 500. This is looking back the last 3 years, and just to kind of get the depth of the drop. We had almost a 34% drop that started right at February 20th, and within about 1 month dropped a third of the overall market. And so, however, we've had about a 30% bounce since that time, and as you can see here on the chart, that a 30% bounce, even though we dropped 33%, doesn't take us all the way back up to the top. And I've reviewed this in past videos, but the further you drop, exponentially more that you have to return to get back to where you started. So a 33% drop would take a 50% drop to get back to where you started. However, it's a pretty good bounce so far. So that's the large U.S. companies. Let's look at some small U.S. companies measured by the S&P 600. And as you can see here, if you look at the beginning of the year, the COVID-19, and when that started happening, small caps started dropping a little bit earlier than large caps, and they're actually down 36%, which is more than large caps over the last month or so during that big drop. However, if you look back since August of 2018, small caps have really underperformed over the last 2 years, and they're down 46% since the high that it made in August of 2018. Unlike the S&P 500, as you saw in the last chart, going into 2020, small caps never made another new high, a high above that prior high of August 2018. So, however, they have started bouncing pretty strong recently. They're up 28%. We feel that small caps are a better value right now, even though they're a little bit more volatile. Over time, small caps are the best returning market cap or size company of all the different indices, and they tend to have the best long-term returns, although they can be a little bit more volatile in the short term. But if you look here, this chart goes back a little bit further to 2014, and the lows that we recently hit are at levels that we haven't seen since the last 6 years ago in 2014. So we believe that there is some more value in small caps, and have been adding to small caps as the market dropped in late February and early March. And we believe that will work out in the long run. So switching here to the international markets measured by the MSCI All Country World Index, ex-USA, it's a mouthful, but what that is that's international markets and emerging markets, and not including the U.S. markets. Very similar to small caps. They never did get into and again, we're looking at a chart that goes back 6 years, but they never did reach a new high in 2019 like the S&P 500 did. So they're down almost 46% since January of 2018, but since the COVID-19, the pandemic started, they're down 33%. They've had a 20% bounce since the market started bouncing. Now let's look at a couple areas that have been doing well during this whole time. A couple that we've been mentioning are bonds, and then I'll touch on gold here in a second. But you can see bonds since January of 2018. This is the aggregate bond index, so this would kind of be more intermediate term bonds. They're up 17%, and you see a pretty strong trend as usually bonds tend to go up as interest rates go down. And really since 2018, interest rates have been going down, kind of climaxed by what the Fed did this year, taking interest rates down to 0. So that's been a strong area over the last 2 years or so, especially this year. And as we mentioned in other market updates, long-term U.S. Treasuries, which are longer term and they're purely U.S. government bonds, they tend to be more of a safe haven. And when you go into bad economic times, they go up a lot more. But they're up almost 40% over the last year, which is a segment of the aggregate bond index. Looking here at the at gold, as you can see, gold. This goes back a lot further. I mean, this goes back, almost 15 years. You can see really strong going into 2011, and then it was weak from 2011 2015. But as interest rates have started going down, and as quantitative easing or printing of money has started back again over the last couple of years, it's really strong. In fact, over the last 1 year, it's up 32%. So, and this is an area that we've been talking about that we hold, that it helped our clients as the market went down, along with those long-term U.S. government bonds, also helped as the market was going down. As we've been talking about, over the last few market updates, we rebalanced twice when the market was going down, selling some of those long-term U.S. government bonds that we were overweighted in as they were going up to buy some of the areas that got hit the hardest, like small and mid caps. All right, now shifting gears for a second, this is the daily confirmed COVID-19 deaths on a world level. So, and the reason why we're looking at this, and again, anytime I show these, I never want to come across as not being compassionate, but my job is to, take the data and try to build a theory of what we believe is going to happen so that we can navigate these markets with our clients' monies. So as you can see here, you had deaths start to peak. These are daily deaths that are recorded, and they started to peak kind of mid-April time frame. And now you can see over the last few days, we've actually had the least amount of deaths recorded in almost the last month, which is very encouraging. And I'm just going to go through kind of country by country here. This is the United States. So the United States peaked about the same time as the world peaked as a whole, and definitely been trending down here over the last few weeks. This is Spain, and Spain, along with Italy and some of the countries in Europe, are one of the ones that got hit really hard in the beginning. So they peaked a lot earlier, and as you can see, really have started to drop off a lot. This last data point is inaccurate. Sometimes these countries will report every other day. So obviously they didn't have 0 cases yesterday, but the important thing here is to see that the trend has definitely been going down in deaths. This is Germany, same thing, trend's been going down recently. And then one of the most important ones to kind of measure from the standpoint of the earliest, the country that got hit the hardest early on, outside of China. Okay, so you can see Italy, and the reason why it's important is because the world and the larger money and that are, that kind of makes up the markets, it was watching Italy to see what was going to happen. And the theory is, well, let's see what happens in Italy, because most likely that's going to repeat in other countries, maybe at different time frames. But since they were one of the earliest ones to get hit, they were kind of, I don't want to call it the test subject, but they were kind of the guinea pig, if you will, of seeing what was going to happen. So you can see they peaked around March 22nd, and it started going down in the number of deaths, and they've really gotten a lot lower. And a lot of the models that we're seeing are actually showing Italy kind of having no more deaths reported kind of mid to late May, which is extremely encouraging, and hopefully that ends up being true. Now, the reason why I'm looking at this and tracking, all the deaths of the coronavirus is because these are linked to the market. From the standpoint of, if you think about it, as deaths start to decrease, as the cases go down, then economies start to reopen. So as that happens, then the market would be encouraged that the economies are starting to reopen, therefore businesses will start get going and revving up again, and that should help the overall economy. So this is the United Kingdom, very similar, still trending down. But this is the chart I wanted to show you here. So if we look here at the S&P 500, and this is up top, the S&P 500 is up top, going back to around January 25th. And then you have the Italy down here at the bottom, this is actually showing the number of cases, not the number of deaths. And as you can see here, when the number of cases topped in Italy was about the time where the market bottomed. So there's an inverse correlation here between the number of cases and deaths, for that matter, and the stock market itself. As the number of cases and deaths go up, then the stock market goes down. As the number of deaths and cases go down, then the stock market goes up. So that's something that, it's really important. That's why I'm spending so much time looking at the coronavirus and the chart of all the cases and the deaths, because again, as the deaths and cases go down, then you start to reopen economies quicker. And the more that becomes conclusive that we're kind of coming to an end, the more confident economies become of reopening fully. So we're still in the early stages of that, but remember, the market anticipates the future. So the market's trying to anticipate a day where there are no more deaths and there are no more cases of COVID-19, and that the pandemic is officially ending. And it's anticipating when that is. And I don't like to use the terminology betting, but the bigger money is placing their bets, if you will, within the market as to when this is going to end and when economies are going to start to reopen. So all that to say, the markets have been bouncing and it's been encouraging, and that's been happening as the number of cases and deaths have been going down. And that's because economies are starting to reopen. The market has been going up in anticipation of economies reopening, which is encouraging. So we are cautiously optimistic. However, we remain in a defensive posture, relatively speaking, because we believe there are still chances that, we know for sure that the economic numbers are going to be bad. We believe that was already factored into the market. You had a pretty strong bounce here in the stock market, and as the market bounces really strong, there's always the chance that the market could pull back some and kind of consolidate. So, we don't want to necessarily go all in and buy a lot of stocks, thinking the market's going to go up. While we did do that twice, we did sell out of bonds and buy into stocks as the market was dropping, and that's really helped us really take advantage of the market bounce. But if you go too much and you buy too much stock too early and you're wrong, you could take a big hit. So while we have bought more stocks as the market's been dropping, we still remain relatively defensively postured. And so we're doing that by holding a little bit less stocks, a little bit more bonds, focused on the safe haven bonds, and holding gold. So I'll say all that just to encourage you guys that we're somewhat optimistic that the market's going to bounce, but within our investment philosophy, we always manage risk first in order to avoid any major drop, but always trying to outperform over the long run. So I hope this helps. Hope this keeps you well informed, and hope everyone stays healthy. Take care. If you haven't done so already, click here to subscribe. We frequently upload market update videos on the coronavirus, provide financial planning tips, and relevant personal finance topics on our channel.